Welcome to the Concrete Reinforcing Steel Institute's podcast. My name is Lou Parous, and I'm the president and CEO of the Institute. Today, I'm going to be talking with Ed Sullivan. Ed is a renowned economist, well known in the construction field, and is going to give us his insights into the impact of AI and data centers, the war in Iran, interest rates, and the construction industry as a whole. I hope you can stay tuned and listen to these episodes, and we hope to do it again soon. Thank you very much. Ed, welcome.
Lou, thank you for inviting me.
So we're here to talk about the economy in general and the impact it has on construction. So we're gonna talk about a bunch of different topics here, and I really hope that we have a really interesting dialogue.
Okay.
First of all, tell me a little bit about yourself. How did you get into this industry? Where have you been? What have you done? Give me an overview.
You know, kind of interesting. I started in the steel industry way back in grad school. I worked for the Industrial Economics Research Institute at Fordham University, which at that time had a pretty distinguished Professor Hogan. And I did my dissertation on the steel industry, imports impact on capital expenditures in the steel industry. And
interesting.
And from there, I did some teaching, but I was hired by the CIA to be their steel analyst.
For the CIA.
So about a month into that, well, they switched me over to automotive, and I spent the next 20 years or so covering automotive.
Wow.
And it was only in the last, since around 2000 or so, that I switched into construction, and at that time, it was PCA.
Got it. Okay. CIA. Wow. All right. I got to be careful. Okay. So, I mean, you have forecasted cement and concrete for decades, but how does that give you any insight into the economy?
Well, construction is a critical part of the overall economy and employment, et cetera. The critical forces that are impacting construction activity are also impacting other sectors of the economy. So it's interrelated. I mean, the economy is very broad in terms of what and how it impacts things in construction.
Mm-hmm. Got it. So, set the stage for me. I mean, we've had 3 years of decline in cement consumption, fell 1.5% last year. What is this downturn made of? Is it really a downturn? Is it just a blip? I mean, what are we looking at here?
So you're right. It's been 3 years. We've seen cement tonnage decline by about 10 million tons. Capacity utilization rates have gone from mid-80s to the high 70s. So it's been a significant decline. The key culprit has been inflation and high interest rates. The high interest rates hurt the private sector. The high inflation hurts the real spending activity that goes on in the public sector. That's been the 1-2 punch. Now, if you look, it seemed that we're about to change things around this year.
You said seemed.
Seemed.
Past tense. Yeah.
First 2 months, we saw inflation decline to about 2.5%. Interest rates were following that path. Look, it was, I think in February, late February, mortgage rates were below 6%.
Mm-hmm.
That's going to start reviving the residential sector. It will also, given lag, help revive the non-residential sector. We were optimistic that this year was our last decline. Well, then Iran happened. That changed not only the inflation outlook, oil prices rise, inflation rises, etc., but it also changed the certainty or uncertainty that people who are going to invest in buildings, etc., faced. So what we've seen then is that the conditions impacting construction activity changed dramatically, and they remain in that. The big issue for me right now is it doesn't seem like there's an exit strategy for the Iran war. And with that, that suggests that interest rates will decline slowly. And that means the conditions that have given rise to the decline over the last 3 years remain in place.
Okay.
And so it's likely that 2026 will see another modest decline, a saddle year, not declining too much, and if that's an error, not rising too much.
So you think it's more of a trough, not necessarily recovering yet, but we're in the saddle.
Correct.
All right. Yeah, I was reading your note from a few months ago that you called the economic resilience in the face of weakening construction data. I mean, this is, it seems like every time I look at the news or I open up and read a newsletter, it's always later, like recovery's later.
Yeah.
It's always coming later. It's promised.
Yep.
Trust me, bro, it's later,
Yep.
I mean,
Yep.
it's funny, and you get a little bit of fatigue from that too. But I mean, April payrolls, you kind of went down. In fact, I mean, there was a lot of back and forth on payroll data for May and June and July. I think it was up, then it was down, then it was retracted and revised, and now it's down. So it's hard to even track this anymore because of adjustments. And we can have a separate discussion about if those adjustments are accurate or not. But I mean, walk us through. And you had actually at that point said that a strong jobs report actually pushes the recovery for the construction sector back.
Sure.
Can you explain that to us?
Because a strong labor market report suggests that inflation won't start to ease as quickly as we had thought. And so a stronger economy puts more demands on everything. Prices remain elevated. And again, interest rates follow inflation. So if the inflation doesn't come down as quickly, interest rates don't come down as quickly.
Right. Okay. So, I mean, a saddle year, right? So I see that's we're in the bottom of the saddle, but I mean, it's kind of like walking a tightrope, right? I mean, what could trip us into a fourth year of decline on cement or concrete consumption, and by default rebar?
There's two issues. Number one is a continuation of the Iran conflict. Shipping through the Strait of Hormuz remains restricted. Perhaps even the conflict widens. Second issue, and this is a more recent event, is that we've seen that the IJA, the Infrastructure Investment Jobs Act, expires in September.
Yeah.
Well, both houses have decided that we'll put a continuing resolution in effect. And that goes through early December. It's likely that will be followed up with a second continuing resolution because I don't know if they're going to be able to make a resolution before the new Congress. It's likely it gets pushed off to the next Congress.
Right.
Well, that adds uncertainty. That actually, even under the continuing resolution, steals some funds that otherwise would have been there away from the funding mechanism. So now what you've got is, in the context, is elevated inflation, elevated interest rates, and increased uncertainty surrounding the infrastructure bill. Those are three powerful forces to lean against. And that absolutely could hit this year and also into next year.
Have you seen a time in the past where we've had three such powerful and impactful forces hitting the economy or an industrial segment at the same time?
So, I mean, the Great Recession. You had everything.
You're scaring me.
The Great Recession was the aftermath of the housing boom and what have you. You did see. But what you also saw is action taken by Congress to support construction. That's when we saw some emergency programs come in, what have you. Given the fact that while there was support, those programs impacting construction still take time to unwind and impact the industry. So you had some pretty significant headwinds back then. This is right now, they're headwinds. They're enough to push off growth, but they're not powerful enough, given the underlying strength in the economy, in my mind, to create significant declines from where we're at right now.
Okay. So there's a glimmer of hope.
I think there is a glimmer of hope. And as you go down the road, because there's so many things that are uncertainty, as in any forecast, that prospects of hope burn a little bit brighter.
So I know we're going to talk a lot about interest rates and tariffs and the war and all these things later, but so I don't want to dive in too much into that. But at the same time, I mean, it seems like the economy, or let's say at this point, our economy is in a little bit of a headspin. We have real prices rising at grocery stores, for durable goods, and at the same time, we're kind of told that, hey, this is not so bad. So I've never really experienced in my life such a counter narrative to reality. And how do you think that variable plays into the recovery? Because all of the recovery really depends on is confidence, right? Yep. It's investor confidence, consumer confidence, government confidence. It's confidence in that, I'm going to be able to keep my job for the next 10 years. So how do you see that variable in this dynamic?
I think you could argue that some people suggesting that things are a lot better than they really are. Okay. At the end of the day, families, businesses react to what they see in front of them, not what someone tells them is going on.
Fair.
And so when you look at the economy, a few things to look at. I would think in the context of high inflation rates that you'd see some cutbacks in consumer spending, and yet consumer continues to go very well. I would expect that overall GDP to weaken. And it has a little bit, but it still remains pretty healthy. You take the data center, take AI out of it, and what you get is roughly a 1% decline, or 1% off the growth rate. It pushes it closer to 1% growth.
Wow.
That's pretty anemic.
Yeah.
You're starting to see some of that show up in the job market. Look, at the job market remains tight because even though the job growth is slowing, the new entrance to the labor force is also slowing. You've got increased retirees.
Sure.
You've got less immigrant. And so if the labor force pool doesn't increase that much, and even if jobs slow, you don't get much of a change in the unemployment rate. And that's what people focus on. One of the things they focus on is, I think, is the GDP growth rate and the unemployment rate. And the other one is obviously the inflation rate. Those are the three things. It paints an odd picture.
So I'm going to throw you a curveball. Okay. You said that, the consumers react to what they see, not what people tell them. But what if what they see is a mirage? Let me paint the picture for you. The strategic oil reserves globally have been drained since the war. And it's softened the impact of oil spikes that we normally would have seen in such a situation. People don't realize, I think, that even though they're complaining about $5 gas or $6 gas, it could be a lot worse. And it's only not worse because of this false, let's say, wet towel that's laid over the fire. But the fire's still burning underneath. What happens when there's no resolution to the war? Strategic oil reserves are drained or to critical levels and are no longer released at the pace they are. Oil prices and the ripple effect that has on the economy, doesn't that then shift people's consumer spending down, because now they're having to pay more for gas or more for goods and they're not buying as much?
Yeah. That's a great insight. Look, the strategic oil reserves were drawn down, not just by the U.S.
That's right.
Globally.
Okay. Right. That's actually what has helped the entire economy not go off the cliff.
Correct.
China has done that.
One of the New York brokerage houses did a study on this, and they said, "Look, if you didn't do if this continues, given now that you've already drawn down the reserves as much as you can, if this continues and there's no increase in the supply, you could see the oil prices go up to $150 a barrel. That's significant.
Yeah.
It's oil. It's energy. It filters its way through every corner of the economy. It will show up in the overall inflation rates. And there you go back to what I said. Interest rates follow inflation. That not only prevents the improvement in interest rates, it could actually force it the other way, that interest rates could actually rise. So, yeah, it's an issue that could play out, and there's some suggesting that there's a not small chance that it could materialize.
Okay. So what I'm hearing from you is that interest rates, that's one metric that people need to pay attention to.
Absolutely.
So our members and listeners are very interested in trying to figure out what's a signal. Like what kind of red flag should I be looking for to inform my decisions in my business and in my life. So interest rates is one, it seems, right?
Yeah, I would look at the interest rates. That's clearly one. In my mind, there are two sets of sequences going on. They call it bifurcation of consumer. In other words, people who make a lot of money, they really haven't changed much in terms of their spending habits. Yeah. But people at the lower end of the spectrum are really struggling to make ends meet. So what, in my mind, the concern is, do the people who are struggling move up the income ladder? The longer this goes on, the more difficult it becomes for even the next lowest income to make ends meet. So what that suggests to me is they'll probably try to keep the standard of living up. And they'll do so by relying heavily on credit card debt.
Ouch.
And if you look at credit card debt, it has increased significantly. Now, we've seen an increase in there's delinquencies a little bit, but they're saying, if it's 30 days due, 60 days due and delinquent, you're seeing those intermediary steps increase significantly, which suggests that people are leaning on the credit cards to keep consumers running strong. And that's a potential that means that the economy, consumer spending, 2 out of every $3 that the economy generates, could be heading for weakening going forward. The second part of a bifurcated economy is the interest sensitive. Construction is interest rate sensitive. That's the reason why we're getting hurt more than other areas. So there are some non-interest sensitive sectors. Data centers. AI is one of them. And that's still propelling things. Government spending is a second one. So what you've got is these two forces that are going on in the economy. You've got the less interest rate sensitive, which is dynamic. Data center construction, AI is dynamic. And you've got the weakening portion, the consumer spending, the interest rate sensitive. And so I think you asked earlier, you're getting mixed signals. Well, that's the mixed signals. It's a bifurcated economy in terms of the consumer. It's a bifurcated economy in terms of the sectors that are growing or not growing.
Interesting. Well, I know we're going to talk, later about interest rates pretty heavily in the Walsh Fed. So look forward to continuing that discussion, Ed. Thank you so much for coming in, and look forward to seeing you.
Thank you for having me.
Thanks. Thank you.